Hey everyone, Happy New Year. It's been about 5 or 6 weeks since I made a video, but I'm back now. I took the holidays off and just never got back in the habit. I've also rebranded a little bit. You can see we're called the Weekly Squeeze now rather than E-Mini Weekly. I just wanted to change the name because I want to cover a few more topics other than just the S&P 500. It's mainly all I trade, but it's not the only thing I'm looking at. So I wanted to bring in some new charts, which I've posted a few of these on Twitter recently if you follow me already. If not, go ahead and follow now. No, we'll get into all that. It's been a kind of a crazy month, obviously. I hope you guys are still in the game. But first, let's get through, before we get into charts, let's get through our disclosures. This is not investment advice. This is for educational purposes only. I'm frequently wrong, like we all are. Trading is extremely hard. But hopefully some of this stuff can help you as you sort of plan out your week, and you can maybe add some of this to your routine. That's my only aim here. So anyway, with that being said, let's get into it. So let's start with the SPX. That's what I always start with. Obviously in the middle of a 10% correction. Now, it doesn't feel normal because we've had such a great run going into this, but I'll remind you that 10% corrections happen every 10 months to 11 months on average. It had been 17 months since we had one going into this, I think. So it does feel a little awkward, especially for new traders because they may have never seen one. But this is part of the process. I've written this before. Markets pull back 5% 4 times a year. One of those extends into a 10% correction normally. So, like I said, it's been a great time going into this, but all good things come to an end. With that being said, I think the days of having those all-time highs every week, we had 70 all-time highs last year. That's more than one a week. I think those days are behind us, and I think we're going to move into what is actually great for traders, which is a range for quite some time here. And I don't think that we make a new high until maybe the fourth quarter, but I'll get a little bit more into that in a little bit. But here's what we have right in front of us at the moment. As always, I normally have two lines here, one green, one red, one for the highest call level, one for the highest put. They happen to be at the same level, so I've got them both here. So 4,600, that's your line to gain, your first down marker. That's not the only one. There's a couple in front of it. We've got a lot of work to do for bulls. Sellers are clearly in control other than Friday. They seem to have given up a bit. But you didn't see a lot of that put exposure come off. The reason that's important, and you can see why we really tailed off once that level broke, and it's because market makers are having to, or the counterparties to all these open put trades are having to hedge their bets or hedge their positions, and so they're having to short into this, and that's what's been happening along with people panic selling. This level has been important in the past, and it continues to be and will continue to be. So let's go look at the options chain real quick so you can see visually what I'm talking about. So here's the 4,600 level. There's the calls, 26,000 open interest versus 22,000 open interest for the put. If you go up the line, you can see it's the highest level with 4,500 right behind it. And look there, same here on the call side. So this is actually your first line to gain, 4,500. If we can get above there, the whole dynamic starts to flip to where dealers are going to have to start buying instead of selling to hedge exposure. Meanwhile, that would cause that chart to look very bullish, which would probably cause a lot of this put exposure to come off, meaning people will just take profit on these. They'll be done with it, and then we're off to the races. But, and I'll pull up my ES chart. Here's where I think this is sort of a roadmap. I posted this on Twitter the other day. We have not closed below those September lows. That was our last, major pullback other than that December scare. We tried and tried, but you got buying tails all over this. So when I say the low, that's the lowest tail. Those were buying tails as well. You can really look at the body of that and say 42.90 is more of the level, right? And if you look intraday, look where we rallied from, guys. So these levels have been strong. It might be just a short-term give up by shorts, by bears, which could give us a nice little relief rally. And that's really what you got to call it for now. I expect us to come back toward this oval. If we can get above that 45 and above that 46, this is the decision point for the market, I think. This was where we topped out at there. It would be a nice little head and shoulders for all you pattern wizards. I'm not real big on patterns, but if they're there, I got to honor them, right? You got to respect this stuff to some extent. And so the market's going to have to decide at this point, are we going to make new highs? Or are new highs justified? Or should we go chop around a little more? My expectation is that we go chop. I don't know that we're going to have a lot of good news that's going to push us over this and bring in other time frame buyers to make this go higher. But so this is what we're looking at. Those are your big levels. They're 45, 46, and onward. Wanted to look at the Nasdaq as well while we're here. I posted this chart on Twitter. Kind of interesting. So the reason I have this level carved out, and this goes back to 1998, believe it or not, 1999, so on and so forth. So back when we started having that volatility in the spring of 2021 in the Nasdaq, not so much in the other indexes. I noticed that we had a 10 or 12% drop in February, March of last year. And it looked strikingly similar to the setup from 98 to 2000. And so I went and carved out the percentages, the moves during 99, or let me go back to 98. And in the fall, the Russian ruble collapsed. And that caused a 20% drop pretty quickly. It got eaten up pretty quickly as well. Went and made new highs. Going into that Russian ruble collapse, everybody was saying irrational exuberance, markets in a bubble, so on and so forth. But anyway, we had that big washout, market ran, and then you get into 1999. Every quarter in 1999, there was a 10% correction in the Nasdaq that did not necessarily correspond to a correction in the S&P or the Dow. What that was the market digesting that outperformance in tech. And so it was rebalancing slowly, trying to rebalance it, but it ultimately couldn't. And you get to that last correction in the fall, or in the Q4 of 99, and from that bottom, Nasdaq doubled in 5 months, and that was the bubble. So when we started going through that sort of churning back, started in around the election in 2020, and then you get into March and we had another correction. I said, okay, this looks familiar, and I mapped out, I made some checkpoints. And so what this level was, 15627 is what it is, was my checkpoint for June of 2021. Obviously we didn't hit it, so I was wrong, but I left it on the chart and observed, and sure as hell we get into this August, September, and we hit it and we rolled off of it. Went and broke it. We did this number. It acted as mega support. And if you look really closely, you can see when we lost that level, finally, that was what kicked off the madness, if you will. And now we seem to have found support, and I expect us to go retest it. And then that'll be decision time for NASDAQ in that 15,600 level area. if you follow volume profile, let me switch real quick. Let me change this. Okay, thank you for your patience. It hits here too. It happens to be the VPOC area, volume point of control for year to date. So a lot of interest there. This is what's the market's aiming for. That's what Nasdaq. That should be a level where we have to make a decision. So that's my next spot there. If we can get some legs, we've still got a lot of work to do, as I said. Next market I want to look at is the Russell. A different picture here. You can see this is the weakest of any of these indexes we looked at. You notice I skipped over the Dow. I don't look at the Dow. It's a ridiculous index. But if you really, in reality, the Dow has done better than any of these others this year so far in this short 30 days we're into it. But I'm going to stick to these indexes because it's what I watch. But anyway, what I notice here is this is the top from 2018 and the Russell. And we didn't really break it until this recovery in 2020. So what this was the market saying we're in a new cycle. This was a bear market. We're in a new cycle. And so small caps should lead at the front end of a new cycle. That's how it works. And we went up pretty quickly, no real tests, and then chopped around. And now we've rolled over here in the Russell. And it's gotten its ass kicked. And can't seem to, and if you notice, this shorter term chart really didn't accomplish anything on Friday, whereas the other indices look strong. They were above their previous highs, much more convincing move. And so the reason for that, in my opinion, is that this was not a cyclical reset. All this is air. The Russell outperformed for no reason. We are still in the old cycle. And generally speaking, late cycle, mega cap stocks outperform small cap stocks, period. And so the market's sort of digesting the fact that they were wrong, that we weren't in a new cycle. And that's why small caps have gotten their asses kicked so bad. Now, so what I expect though, even though I say there's air here, this is ultimately where we're going. I actually think that we had higher here as well, because it's going to get dragged up with the rest of it, with its cousins. I just don't think it's going to get that much steam. It's going to continue to underperform, and I think that we're going to stop somewhere in here. So that's decision time for Russell, and ultimately I do believe we get here at some point, whether it's next year or later this year, who knows. But I guess the general consensus here should be to expect a choppy year. And I believe that the Nasdaq and S&P 500 at some point in Q4 make a higher high, and I'm still targeting 5,100 on the S&P. I believe that will hit before anything changes. The other things I wanted to look at here, I want to touch on a couple others. This is bonds. Looking at the 10-year Treasury, you can see where we held. I shouldn't have put this. I wrote this wrong. It says pre-COVID bottom. I meant to say spike base. This is the spike when COVID came into play. When you get up here, this was extreme bubble territory for bonds, price-wise. You were paying $200 for every dollar in interest on a 10-year Treasury at this point. That's absurd. Highest it's ever been, obviously. And it was like 0.5% on the 10-year. So this had to get trimmed off. It took a long time, but they finally did it. And rates have normalized, I would say. I would expect them to actually go higher, which means the price of this would go lower, but not right now. Looks like they had a pretty strong double bottom, which if you've watched my videos, you know that double bottoms to me are sort of a sign that we're in a downtrend. This is clearly in a downtrend. But it was a higher low, so that should create some sort of relief rally in bonds as well. I don't know how high it goes. Probably could watch this little trend line and say right here that it's hard for me to believe that it would even get that high in the circumstances. So keep your eyes on this because it says a lot about, the bond market's huge compared to stocks, and it's going to say a lot about what people are thinking moving forward about the economy. Are we going to go into a recession, whatever, so on and so forth. But if these start tailing off again, going down, yields going up, it could spell trouble for the small caps and for your growthy tech stocks. So keep your eyes on the bonds. They're very important, obviously. Last bit I wanted to look at was the gold. Now, I believe the gold chart is a perfect example of efficient market theories. Efficient market theory. So you've seen the meme probably where somebody says, "Hey, I knew inflation was coming. I told you," and the other guy says, "Well, you must have made some money then, right?" "No, I bought gold." "Okay, well, this is the COVID bottom, okay?" And gold went on this huge rally. This was the market front running inflation. If you think back, inflation was still running at about 2% back here. And we didn't get that really big inflation print until March of 2021, right here, when it went on its tear. But this was the big rally. So it was front running it. So it was buy the rumor, sell the news. And then right now we've just been chopping and trying to figure out what's next. This kind of spells out what I just described for stocks, except I don't think it's going to be as orderly as this. But this would be my expectation of what the S&P and Nasdaq might look like coming forward. Not perfect, not falling into this nice little wedge, but not making new highs necessarily until there's a reason to. So it's digested inflation. Stop trying to chase that trade. But regardless, it's still a very bullish setup. And we had this huge drop this week in gold. Everybody was expecting it to rip here. Everybody on FinTwit expecting this channel to break. But then Tuesday morning, you got Goldman Sachs come out and say, buy gold. Of course, they're counterparty to a crowded long trade, so they want it lower after they make that recommendation. And then you also had Powell coming in and just smoking this thing. Basically, just he ran the dollar up, and when the dollar was going up, this was going down tick for tick with it. So here's what I expect here: is that gold is famous for running stops. You see that? You see that? It always does this. It runs stops to get liquidity. Think about it. When this channel breaks, there's a lot of buyers who have their stops here, and then you have breakout sellers with their sell stops here. That is liquidity for people who want to buy it, i.e. Goldman Sachs and their clients. So that's what I expect. I would watch this area right here and see how the market reacts, and it could be a pretty strong buying opportunity to at least move back to the top of this channel, or to this wedge, whatever you want to call it. So that's what I'm looking at this week, guys. I hope that this was helpful to you, and I hope you have a great week. And feel free to ping me if you have any questions. I'll have this posted on Twitter here shortly, and we'll talk soon. See ya.